Good evening. Ira Epstein of Linn Associates with your financial market wrap-up for this Wednesday, October 28th, 2020, getting on to 6:30 in the afternoon now. All right, so I say afternoon. It's actually the evening. You know we're going to fall back in my Midwest time zone this weekend, so we go backwards in time an hour, and of course we're sort of out of sync with what Europe is doing. What a crazy day, right? You woke up and all of a sudden the world was ending. I had been up early, as many of my subscribers already know, and I was looking at the markets going, whoa, what an interesting time. I say interesting because I was prepped for this. I have been writing in my reports that I thought volatility was going to get up rather dramatic, and it has. The VIX, for example, is into the 40 level. The currency VIXs, if you look at the individual ones on the markets, they are very, very strong right here. So you're getting plenty of plays backwards and forward here that I think are interesting. What's spurring everything on? Well, it's a combination. The election on Tuesday, and it's getting to be, as I see it, a closer race than the polls first had it laid out to be. The next thing that I see in the market is we have nothing out of Congress. That's over. You're not even hearing about it. You will, in a big way, once the election's out of the way and maybe some of the legal battles that are coming. Oh, yeah, I didn't tell you that. There's going to be a massive amount of legal battles. Who knows when we'll know what the presidency is going to look like, but they're coming. The next thing that's going to come after all that is what are we doing with COVID? Now, Europe today, both France and Germany are going into lockdowns again. They're not as modified as you might think. They're more similar to the first wave. Both countries are expecting just as bad a situation, and they're biting the bullet, which means those restaurants, the theaters, everything that they were opening, they're going closed again. In the U.S., keep this in the back of your mind. Europe is just several weeks ahead of us typically on this. Then we catch up. It just seems to be how it worked last time. I think it's going to be darker before it gets lighter. Obviously, the one thing that could change everything, if science would come up and say, okay, we have a new COVID treatment or whatever. Well, I'm not seeing that to be the case, and I didn't like what I heard from the UK Health Ministry when they're expecting that the first whatever treatments they come up with or vaccines will prove to be not as effective as you think. That's going to take years to get, and they said years to get it to that point. So something to think about. And the market, of course, looked at all this and came unglued. When I say came unglued, you're down for the week 172 points. You were unable to get back over on a closing basis the 3504, and instead you've come back down to 3279. Now there's a number of analysts out there that are thinking the 3200 level is going to be the main support area in the market, and that's because of what happened here. So they're looking that if we get a test of that and the market holds it, that this was that additional washout, and they're expecting a recovery like you had there. They're already saying it. I'm watching it on, be it Bloomberg, CNBC, Fox. You're hearing this over and over. But the first wave that you can't deny is this is what you're in, and this is not a surprise. Let's get rid of today completely. You can't argue that you haven't been with lower highs and lower lows. Where are these analysts? This is a downtrend. And until you break a prior high, you're in that downtrend. Now you've accelerated a leg to the downside. Let's put moving averages on this. When you put them on, the battleground shaped up at the 18-day average. I want to take off today. The first, and we talked this just yesterday, said if this lets go, maybe you're going back to the 100-day average. If that lets go, the 200-day average. You let go today there and you came down. What else do we look at? We look at a Bollinger Band. The Bollinger Band is this black dashed line. The market is going to trade within these bands 95% of the time. Unless you get an embedded reading with it where the market generally locks on and stays with that band, and you'll get them in times like this from different areas, or this. You don't have that right here. You just have an oversold market. You had an overbought market that got here, and when it turned back down, the momentum went with it. I do think that we're in an area that the quote-unquote smart money is pulling in their shorts here. You've got the combination of the 100-day average, the lower band. If you'll recall, I told you that when the market had fallen back into this zone, if you went into your weekly charts, I think that the professional money, the long-term money, was buying the 100-week moving average of closes. I have not changed my opinion. I think they're probably doing it. They could have taken some money on the way up out, buying again. I think that these traders are looking at an event in their minds, that you're getting all the bad news you can possibly get right now, and as we go forward, there's a lot of good that's going to happen. I'm not out of that camp, in that camp. I look at this on a daily basis. That's what I judge it. And when I look at my weekly charts, I put on a completely different hat, and I look at that. And that's what I cover on Saturdays for my subscribers. On Saturdays, I cover all these charts, much more than these actually, and I go to that method. In the NASDAQ, what do I tell you over and over on these videos? The first time you hit a Bollinger Band. If you're short, and in order to get down to it, I'm assuming you're short, that's where they cover the shorts. Do they have to cover every single one? I can't answer that. They'll certainly jam their stop down. If the market continues lower, they have the 100-day average. Where's the resistance? It's back up here. But when you're oversold, I don't look for the bears to be very defensive of their positions. Why? They've already lost that momentum. So got to be careful of where you're at. Obviously, we've gone more than 2 days now without taking out 11,695. You had an outside day down. I was looking for the bears to defend their position at the 18-day average and for it's called a bear trap to develop if you got over 11,695. It didn't happen. If that happened, I would have been looking for the market back up at the 12,000 level as a chartist, saying it shouldn't get then back down here. But you had it now see the next day. Now that you're down there, no, that's not it. You can't do it anymore. I don't care if you take out that high. It's not the same trade. It only gives you the 2 days. I've done my research on it. I'm very comfortable with what I'm saying. So I do think you're getting short covering that's coming into the market. I don't care if it goes further down. That's what I think, and I think you're going to get a wave of some people that want to buy those markets. I'm talking longer term. Obviously in the Dow, forget today. You were already, and this was on Tuesday, got it? So on Tuesday, it hit the Bollinger Band, now 2 days in a row trying to hold it. If it gives ground, look for the 100-day average. The market did that, sliced through it. Now I think your big bulls traders that like candles and say, I want to own at moving averages, the 26,000 level could be their area. What else do we see? I want to backtrack right here. Day one under the Bollinger Band, day two on the close today. The rule of thumb is that each consecutive day that you're under the Bollinger Band, you take away for each one of the percentage points that 5% of the time the market is under or over. That does not mean you're looking for the market to buy it and it's going to spin. Gives you an idea of how excessive the market is getting. Day three could be today. So you'll get to the day four period or so, and I'm going to say, hey, I think the odds favor you're going to make a move to the right-hand side. I'm already there. But does that mean that you're a buyer for that? No, that's not what it says. Do I ever tell anyone to go short under a Bollinger Band or long over one? Never. So I just think there's better opportunity. That's what it tells me. We then get to the Russell. Same thing. You hit the Bollinger Band for the first time. I think the smart, quote-unquote, money is coming out of the market. I think the longer-term boys are looking to come in against the 100-day average there, too. In the VIX, 3 days in a row, up and over the upper Bollinger Band. Now, what's interesting on this one, you had sideways action. You broke out to the upside. The question is, was it real? And then we started seeing the market hanging there over it. I said, it's overbought, it's over it, but if it's real, watch out here. And now you're making an attempt. The word is both numbers have to get over 80, go sideways for at least 3 days in a row for it to embed. Then I think it's going even higher on you. You're not there. You've got 3 days in a row where you don't have both numbers over 80 on the slow stochastic. Yeah, it's a run to the upside. Enjoy it. The market's been over the 18-day average. It's had a bullish, if you can see this, see these, it was crisscrossing back and forth, the 18 and the 100. Got back over it, and now it's holding it, and that's your breakout to the upside. Okay? Bond market. Why didn't the bonds run wild today? I know they've come back from 171.22, that excessive low up here. Again, what did I say when we hit the lower band? Go back and look at these videos. I'm pretty sure I would have said, first challenge of the Bollinger Band, I think the quote-unquote smart money is coming out of the market. You're back to neutral. You're into a sell zone at 174.3, but the dollar risk is monstrous. It's over $2,000. When you get over a certain amount of money, like 600, I have filters on trade ideas. I learned many, many years ago that you can't just blindly go in as a chartist and say, I'm bullish, I'm bearish, I'm buying. You've got to deal with the real world. What is your level of pain? What have you done your research on that if the risk is too big on a chart, even though you're getting a sell or a buy signal, it should be voided because the dollar risk doesn't make any sense. You've got to do your homework. I've done mine, and I teach it in my charting course, all these different techniques with it. So as I'm looking at the market, I'm expecting a battle at the 18-day average of closes. 10-year notes, same thing. It couldn't even get to the 100. And you've got a lower low, higher high pattern. Couldn't make it up there. Corrected an oversold condition. It is not trending. We then get to the dollar index, which for the first time today, here's the market as of yesterday. It has been fighting at this 18-day average and staying under it. You had one swoop down to the lower Bollinger Band. What was the play? If you got down there, you're supposed to cover shorts. Smart money covers shorts there. Now the market's thrown out another buy signal. The buy would be at 93.30. That's what I think the bulls are going to defend, but I don't like the number. They've got to defend it, and you can't let the market get under 92.73. That will be the key number that they don't want to get under. I do see the bulls trying to move this market and see if they can jam it higher. Watch that 92.73 level. Eurocurrency, bearish. How could it be bullish when you've got France and Germany both going into a shutdown right now? So if you're thinking, oh, it's going to look good, If you're nuts on these emerging market plays, be careful when you get these currency moves like this. Lower high, lower low. I'd love to see it hit into this area because I think as a traditionalist in charting, that's a perfect zone. In other words, where I could see the smart money taking something off the table. I see resistance at 117.96. You don't want to see prices if you're a bear get back over 118.73. But more or less where you're really at is sideways action. And it's a broad sideways from 118.87 down to the 117.05 level. And that's what I'm watching more than anything else. In the end, trend is up, overbought, hits the Bollinger Band, backs off, hits the band, backing off again. But it's basically trying to ride that band higher, and you would expect that. It's not that the Japanese economy is so good. It's that traditionally you look to Japan as a safe haven currency to get away from plays in America and or Europe. Still acting that way. Bitcoin, outside day down. So for the first time, a big chink in the armor here that has been bullish. Now, keep your eye on this because if you get them close under 80, you probably want to say, okay, more of a correction setting in. Not yet, though. Haven't done that. Got to do that part of it. Down here, you're still going to catch buying because you have an embedded reading. Embedded meaning both numbers in the slow stochastic are staying up. in the differential between Brent and WTI crude. This battle has been just going on here against the 18-day average indefinitely. It just keeps moving and moving, and it's still there. When we take a look at the energies, they got hit today, and it makes sense, right? I think it does. You're getting into lockdowns again. You're not going to be driving cars. Airplane travel's not going anywhere. The cruises aren't going anywhere. You know, who's going on any of those things at this time? Even though in airplanes, if you breathe the air, it's really ultra safe with all the filters they have. But it's not how people are. They got to sit next to that person. They're scared. So you broke down under the Bollinger Band. What are the odds of staying under it? 5% of the time. You did that here. You've done it in other areas. You have a tendency to come back. This market does not like to stay out of its Bollinger Band. Certain markets tell you that more than other. That's one of them. WTI, same thing. Oversold. Now, I still don't know what the trend on this one is. I put this arrow back up here, but it's wrong. This high is higher than that one. I always have a problem when that occurs. You had an outside day, you took out the low, and the market let go. So I always look to see what an outside day does. Heating oil, cover short areas, what it's screaming at me. Doesn't have to scream it to you. The market had been in a downtrend. First challenge of the lower Bollinger Band. Duh. It's also winter. You know, it's getting cold. Cold weather, I don't know. I remember people are going to use heating oil. They're going to turn on their furnaces. They're going to, not everybody has heating oil, but they have natural gas too. So hard market to want to be short as you're entering the cold weather season. And in nat gas, the pattern turned bearish today. You've got lower highs, lower lows. They're looking for a very small build tomorrow in the natural gas from the EIA. 35 billion cubic feet, not very big. Normally you get about 90 billion at this time of the year. Look for the support back in this area. The market is not an active short. While the swing line's down, the bias is up because you're over the 18-day average. I call it nothing. I get a lot of traders that they look at the futures, they go, you know, they're pretty risky, those futures, so they'll trade based on the futures ETFs, and I do get it. It makes sense for a lot of people. So each day, I publish an afternoon video for them. It is a subscriber video. I'm going to cover the shorter term and swing charts. Now, what's the difference? A swing chart is, in essence, a chart that's made up of the day-to-day action, and sometimes it flows. It can go on for a week, 2 weeks, the trend. When you're dealing with 90% leverage in futures, this is a very interesting way. It's my favorite way of looking at a chart. Longer term positions I cover too, and how I do those are on the weekends, because each Saturday, I'm going to review about now nearly 40 charts in my Spider ETF with specific buy and sell, not based on daily charts, based on the weekly chart. I don't do a weekly chart every day because it doesn't change every day. It's a broader amount of time. So you're going to get that. The charts will look just what you saw there. You can watch it from the desktop, your tablet. Every one of our subscriptions comes with free access to our mobile phone apps. You can watch the videos there. You can chart with it. Get our news. If you take my different levels of subscriptions, they come right through that as well. It works on Android and Apple phones. I'm going to cover and typically start every one of these with ideas on the news of the day. What's coming up, what happened today, and what are the reports coming out tomorrow. I'm going to cover all these markets. You can hit pause if I'm going too fast for you. You'll see the different ones that I'm covering. My subscribers write me. They'll tell me, hey, can you add this one? I do it. If I see one that's not that popular with trade anymore, I'll drop it. I keep adding and going with it. Typical video, by the way, lasts about 20 minutes or so. Cost for it, I try to keep it very close to a cup of Starbucks coffee with the tip. About $8.95 for the large cup. I think you'd agree with me. This could be a little more, but you're getting 30 days. That coffee's 15 minutes or whatever your specialty drink is. You can call my staff. They will explain it. We have on our website, by the way, if you go to research, everything is explained there as well. And if you've not tried this in the past and want a free trial, I offer a 2-week trial to it as well. How do you get it all and how do you find out more? Just go to our website. It's under free offers and the research. And remember, we do talk to people. Give us a call. We'll give you a call back or take it right there on the fly. I'm Ira. You have a great day, and I will talk to you tomorrow. Take care now.